Luxury credit cards in the United States are often misunderstood as lifestyle products, but in reality, they are financial instruments engineered to reward predictable behavior, high trust, and long-term consistency. And understanding this system is the foundation of extracting real value from premium cards issued by institutions such as American Express and Chase. Because credit cards are not income, they are unsecured short-term loans governed by data models that track payment history, utilization ratios, credit age, velocity, and behavioral stability over time. Payment history is the single most important factor, which is why elite cardholders never miss payments and never rely on memory. Instead, automating full statement balance payments so interest is never triggered, since interest is the mechanism by which banks extract value from undisciplined users. Utilization is the second silent force, because even users who pay on time can appear risky if balances exceed optimal thresholds. And this is why higher-limit premium cards and charge cards stabilize credit profiles by lowering utilization percentages even as spending increases. Credit age matters because lenders trust time more than intent, which is why closing old cards often damages profiles, even when balances are zero. Premium cards justify annual fees through structured value, including elevated reward multipliers, credits, insurance protections, and access benefits, but only when users calculate value mathematically rather than emotionally. The U.S. credit system is not moral. It is statistical, meaning it does not care why you spend, only how consistently you behave, and individuals who understand this realize that luxury cards are not about appearing wealthy, but about lowering friction across financial life, reducing risk exposure, and signaling reliability to every lender that accesses your report. Strong credit profiles translate directly into lower mortgage rates, cheaper auto loans, better insurance pricing, and higher approval odds, which means two individuals earning the same income can experience drastically different financial outcomes over decades, purely due to credit literacy. At this point, if this explanation reframes how you see premium credit cards, liking the video and subscribing ensures this content reaches viewers who want to understand the system rather than fight it. Advanced cardholders treat credit cards as infrastructure, not spending permission, tracking balances weekly, avoiding emotional purchases, and aligning card usage with predictable cash flow, because the system rewards calm, repetitive behavior and penalizes volatility. The goal of luxury credit is not exclusivity, but efficiency, and anyone who internalizes this foundation gains access to financial leverage that compounds quietly over time. Once the foundation of credit behavior is established, premium cardholders begin optimizing within ecosystems, because the real power of luxury credit cards lies not in individual products, but in how points, bonuses, and benefits compound across portfolios. And this is where American Express and Chase dominate the U.S. market through transferable points, airline and hotel partnerships, and structured reward hierarchies. Experienced users understand that cashback is predictable but capped, while transferable points offer asymmetric upside when redeemed strategically for premium travel, which is why points earned on dining, travel, and business expenses can represent thousands of dollars in realized value when transferred rather than redeemed at face value. Welcome bonuses are one of the fastest ways to accumulate value, but only when applications are spaced. Minimum spend is met through organic expenses, and velocity is controlled to avoid risk flags, because banks reward planning but penalize desperation. Premium cards also offer protections that reduce long-term financial risk, including purchase protection, extended warranties, return protection, and fraud safeguards, which quietly save money over years, even though they are rarely marketed aggressively. 0% introductory APR offers can be leveraged responsibly to manage cash flow or restructure high-interest debt, but only when paired with a strict payoff timeline, because failing to exit before promotional periods end results in interest rates that erase all prior gains. Utilization management becomes more sophisticated at this level as cardholders distribute spending across accounts, request limit increases strategically, and maintain low reporting balances to stabilize scores even during high spend months. One of the most common errors is canceling premium cards without calculating credit age impact, ecosystem disruption, and lost protections. Because not all annual fees are costs. Some are access fees that unlock disproportionate value when used correctly. Disciplined users document reward strategies, track redemptions, and treat points like assets rather than coupons, understanding that luxury credit rewards long-term thinking and punishes impulsive behavior. If this section is clarifying how high-end card ecosystems actually generate value, engaging with the video helps signal that long-form financial education still matters. Mastery of rewards is not about travel flexing. It is about extracting maximum efficiency from spending that already exists, and those who approach points strategically often outperform higher earners who ignore the system entirely. At the highest level, luxury credit card strategy becomes less about earning points and more about managing risk, reputation, and long-term access. Because banks continuously reassess cardholders using internal data that extends beyond credit scores, including spend patterns, payment timing, account age, and stability indicators, which is why advanced users avoid sudden behavior changes that can trigger reviews or shutdowns. Business cards, when used correctly, separate personal and operational spend, increase total available credit, and reduce utilization pressure on personal reports, but they require consistent revenue representation and disciplined accounting to remain effective. Risk management includes avoiding manufactured spending behavior that violates issuer terms, pacing applications, maintaining cash reserves, and understanding that access to premium credit is conditional, not permanent. The most successful cardholders plan years ahead, mapping upgrade paths, retention offers, and downgrade strategies to preserve account age while minimizing unnecessary fees. Credit profiles must be stress-tested mentally against income disruptions, because carrying balances during instability is the fastest way to reverse years of progress. Elite users treat credit like a long-term relationship, not a short-term exploit, recognizing that banks prioritize customers who generate transaction volume without generating risk. As profiles mature, benefits extend beyond cards into preferential lending terms, higher approval ceilings, and faster underwriting decisions, which compound quietly over decades. The ultimate objective is not to collect cards, but to control borrowing costs across life, because a 1% difference in mortgage rates or insurance premiums can outweigh years of reward earnings. Individuals who master this system rarely talk about it publicly, because real financial leverage is silent, structured, and boring by design. If you want continued deep-level breakdowns of premium credit strategy, risk control, and U.S. financial system mechanics, subscribing ensures you stay aligned with content built for long-term advantage rather than short-term hype. Because wealth in America is rarely about income alone, it is about understanding how trust, data, and consistency interact over time.